Hi, everybody. This is Scott Callan, Chairman of Ichigo. Thank you so much for joining us today for the FY23 so the February 2023 full year corporate presentation. I am joined by Ted Fujita, our lead independent director, and by Dan Morisaku, who is a senior member of finance team and our head of global IR. So let's jump into it. Starting on page 7, 14% dividend increase. Earnings exceeded our revised up forecasts. We had year-on-year earnings growth across all earnings metrics. Specifically, all-in operating profit is up 27% year-on-year. Cash net income up 18%, EPS up 48%, cash EPS up 20%, and the dividend, of course, was supported by robust cash generation and the COVID recovery. Main earnings drivers and what's new and different, very strong hotel market recovery, which we expect will continue. RevPAR was up 85% year-on-year. We sold an asset at Ichigo office, an extraordinary high valuation, which is spectacular. I received a performance fee on that asset sale. And so with the amount of cash coming in, we were able to fund 3 things: growth investments, about 51 billion yen of asset acquisitions, that's plus 63% year-on-year. And that is a forward indicator of where our earnings are going to be going. We invest in assets. Particularly, this is majority of this is Ichigo Owners, which, as you know, has a turnover of greater than 100% every year. So an average holding period of less than a year. So this is going to be very, 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 very good for us. We did share buybacks, 3x them year-on-year, and we began Ichigo office share acquisition, which is currently in progress. And the Ichigo office share acquisition is directly linked to our desire to be the best REIT operator in Japan. One of the things that we think is really important is to deliver alignment with the REIT shareholders. We do that in a number of ways, including owning the shares ourselves, so we can beat our own company. Next page, the summary. Again, I'm going to go pretty quickly. There was a Japanese session before this. There were lots of questions. So hopefully there'll be lots of questions in the English language version of this also. Although one of the things that happens with the Japanese version is everyone is in the same time zone. And so there are more participants. So a lot of people watch the English version on tape or on video, as it were. But anyway, let's see if we have a bunch of questions. As you know, the earnings model is very durable. We are effectively structurally profitable. We have stock earnings that are about double our fixed expenses. Turning to the right side of the page, stock earnings don't move around that much unless there's a cataclysmic event. That's what they are. They're pretty structural. So small moves, plus 6% in sustainable real estate, SRE, minus 1%, meaning flattish. And asset management, the energy was up 5% year-on-year. Next page points to we try to be very clear on what we're doing, and we want to be clear about the metrics that are important to understanding whether we're succeeding or failing. And so we use all-in disclosure and allow you to come and read that, or those who are familiar with the firm, try to give a better what are the drivers of the firm. Next page. And so on that point, the 2 major financial KPIs that you should be tracking us on are all-in OP and cash EPS. They were up 27% and 20% respectively year-on-year. It's a way of saying, EPS was up 48%, and that looks like a much better number, but it's not nearly as relevant. The real numbers you should be looking at are how are we doing on our operating profitability, and are we generating significant amounts of cash? Because we are a firm that focuses on maximizing cash flow to shareholders over the long term. So good news is it was a good year. But you should be looking at the numbers that look more like 20% as opposed to like 40%. If you look at the cash EPS number, 33 yen, today's closing 283. It tells you on this year's earnings are trading about 8.5 times earnings. Given that earnings have been pushed down still from COVID effects, we think the shares represent very good value. That's why we bought a lot of them last year, and you should expect us to be continuing to be active in the market going forward and buying our own shares. Next page, please. The segment earnings details, a lot of stuff moving around. If you look at the all-in operating profit, big increase in asset management year-on-year. A big driver of that was the flow earnings contribution from that spectacularly profitable sale of an asset in Ichigo office. And just to kind of address that directly, one of the things that characterizes us all as a firm is a real awareness of conflicts and making sure the right thing happens for not only our shareholders, the shareholders of this company, Ichigo Inc. 2337, but the shareholders of the REITs that we manage. And this is kind of the JV businesses is rife with conflict. So we have a majority independent board at Ichigo. We have fully independent boards, very unusual, in fact, perhaps unique at the REITs. We do not do transactions with the REITs unless they sign off on it. And in fact, we do transactions with the REITs typically at a discount to what the market price is because there are ongoing asset management fees that come from that. So I mention this because the asset we sold, we actually put into the REIT as part of GE Capital's wind down of its global real estate business. We were a preferred buyer in their part. They wanted to have kind of comfort that this transaction was going to close. We actually sold it to the REIT from the parent company at only a 2% gross margin in a market that would normally take 10 to 15 to 20. So it's a way of saying the REIT got this asset at a really good price. And then we managed it and were able to sell it at a much, much higher price, which was very good for the shareholders. Sustainable real estate, you can see, was up 20% year on year in all-in operating profit. Big driver was Ichigo Owners in terms of the increase year on year. Multi-asset, of course, had a very good year, but the big increase came from Owners. Slight decrease in clean energy, weather moved around a little bit. Not going to move that much, but that's good. Has some impact. Next page, turning to page 13, just to go through some of the characteristics of the business. This is a stock plus flow earnings business. So we have this kind of baked in profitability that comes from our stock earnings, and then we try to do things on a daily basis to grow earnings for all of your shareholders. And this is pretty durable. So to be clear, Walmart, Amazon, they have flow earnings, and they're very durable because they're delivering growth value. And we expect to do that ourselves. But there is a difference between the flow earnings because they tend to be lumpier in our case because they move around a little bit with one can sell an asset. But it has both elements as part of corporate business. Page 14 shows a breakdown in the stock earnings. It's primarily SRE, sustainable real estate business, which is the Navy section. Asset management is relatively flat over time. Again, so this is a stock. So that performance fee that we register on the Ichigo Office REIT is not included in this because that regard that it's flow. As you can see, the clean energy business is growing nicely over time. Next page. Embedded forward earnings is another element of the business model. So this is the unrealized gain on the balance sheet. So we've got about 100 billion yen of shareholder equity, third-party appraisers. So not us, third-party see us as having about 68 billion yen, so plus 70% against shareholder equity in terms of unrealized gains, and it's growing. And that's what we do. We add value to assets and the value grows over time. If you turn to the next page, you can see that not only do we have 68 billion worth of unrealized gains. In fact, when we do exits, when we monetize those gains with asset sales, we come in spectacularly higher than what the third-party appraisers look like. So they're very conservative. So looks something like 2x. So on a 2x basis, it's not that we have 70 billion yen worth of unrealized gains on the balance sheet. We have 140 billion. So it gives the firm extraordinary kind of value that is not recognized anywhere in the accounting and the financial statements. Next page. We also generate economic operating cash flow that exceeds the income. You can see it. This year it's 1.1x, and we kind of look at it and say, how is this possible since we're generating a lot more economic operating cash flow? And we didn't realize that we haven't updated this to show all-in operating profit, or in this case, all-in operating cash flow. So if you used effectively a more correct number, which I would say 2.4x for fiscal year 2022, and for this year, it was 1.5x. We will make this adjustment going forward. We'll be transparent about, and this is what we're doing. But this significantly underestimates operating earnings because we're not using all-in number here. We'll change that for next fiscal year. Next page, please. You can see what's happening in financing. There is a lot of turmoil in the world, and we're not experiencing any of it. So you can see our average financing is flat year on year at 89 basis points. In fact, the financing that we actually executed upon within the last year was done at 86 basis points. So we're despite all the turmoil that's going on, we are financially better off, more stable, financing kind of at extraordinary levels. And this is what is so powerful about investing in Japan. If you're deemed creditworthy by the gods of credit, you can effectively borrow kind of almost infinite amounts of money from nearly free. We understand the difference between the cost of equity, cost of debt. We try to take advantage of this extraordinary, stable, durable, and cheap funding to grow value for all of you active shareholders. Next page, please. We continue to do a lot of work on ESG because we believe in it. And the good news is Japan also believes in it, and financial institutions are very committed. In Japan, there's this very strong societal-wide commitment to try to do the right thing. And so Ichigo is recognized by financial institutions for our principles and for our actions on behalf of trying to create a more sustainable world. And so we are increasingly doing sustainable finance, positive impact finance, ESG finance. The good news is not only is this utterly correct because we should all be working for a better world and a better planet, it also means it's the case that the financial terms are more favorable to us as a borrower. They tend to have no covenants, no collateralization, zero to very little amortization, and actually even lower financing rates. So we're delighted to be involved in this. Next page shows a summary of kind of the total of sustainable and ESG loans, and you can see at this point they're about 30% of our total loan book, and we expect to grow that. Next page, please. As you know, we are climate positive. We have a very substantial, and that's in the green bars, production of energy, solar and wind, and that massively, it's actually 4x our current consumption of generation of CO2. And we will continue to work to expand both the green bar, push down on the blue to expand our current contribution to a better planet. Next page, please. This shows a slightly different metric, which is what percentage of our total consumption is done with renewable energy. Energy consumption is at 70%. We expect to get to 85% this year, with a target of getting to 100% 2 years out. Turning to page 24 of what we did on acquisition and sales this year. Lots of acquisitions, I said earlier. That is bullish for forward profitability. Multi-asset has been doing things interesting in office. As you know, we specialize in mid-size office. It's proven to be very, very durable. In COVID, it is the case that we primarily have SMEs as our tenants. They are using more attractive space to recruit talent in a country with a very low unemployment rate and a shrinking labor force. And so that is actually, it's interesting. One of the hypotheses was that Japanese office was going to be stressed by population decline. It's turned out that population decline has been a driver of growth in offices because, exactly as I said, companies are using better office space and larger office space in a country with very little space for worker as a way to attract talent. And owners continue to be very, very active. We bought 36 billion in assets. It is expanding its sales channels. As you know, we did our first securitized token offerings. So this is digital, but real. I'm not going to make a comment about these other crypto assets that are out there, but these are securitized versions of real estate with real NI attached to them. It turns out there is a very different set of buyers for this. So we have, for example, our REIT owners tend to skew upwards in age. The folks who have been buying securitized real estate tend to be younger, in their 30s. And so it's a brand new market. And look, inflation has come to Japan, trying to give savers a better return. It's fundamentally very important to the society and to defend the lives and livelihoods of Japanese savers. So we're delighted to be able to be involved in expanding the ability for Japanese people to own real estate backed by strong asset management. On the sales side, we sold 55 billion. It's about up 20% year on year. Gross profit margin against sale price is 21% against book value was 27%. So these were very profitable transactions, and they reflect the fact that generally the buyers are institutional investors, and they know the value we've added. So this is not us leaning into the sale channel. This is us being very good at adding value to Japanese real estate. Next page, please. See what's going on with owners. Continues to both acquire and to sell. I think our forecast this year, and this is a little bit of Ichigo thing. We view our earnings forecasts as promises, as commitments to be hit with 100% certainty. And so, as you can take a look at it, you can see that owners we've got operating profit on the page. So we sold 20 billion worth of assets. We generated 3.5 billion operating profit during this period. We're talking about today that this ended. And so our forecast for next year is we're going to sell 50 billion and something under 4.2. So the gross margin for this year was 14% in owners. Again, this is less than a 1 year hold. We're generating ROEs that look like 50 to 60%. For next year, we penciled in a margin that's below 10%. Okay, fine. Super relevant to hitting our targets. But I think it's actually it is our goal always to beat our numbers and beat them substantially. I think there may be some room in there to do that. And without trying to accuse us of being kind of unduly cautious. I mean, there's a lot of stuff going on in the world. Interest rates are really high. There's a war in Europe. There's uncertainty of what's going on geopolitically. But I expect we will be delivering something better than this during the next year. Next page shows owners' business model. It's really rooted in us being very good at understanding tenant needs and delivering assets that respond to tenant needs. And therefore, because we are very good at serving tenants, because to be clear, sorry, I should have said this. Owner specializes in residential assets in Tokyo, generally kind of prime, super prime locations. So these are very good assets, and they're designed to build well, and they target the needs of tenants well, and as a result, have durable returns for the new owners. Because what we do is we buy these assets. We do about 30 assets a year. We do about 1,500 leases a year, meaning 50 tenants per asset. We lease them up, and we sell them, and then move on to our next to the next year. So it's a very powerful business model, meaning it adds real value. It adds real value for the tenants. It adds real value for developers who have us as their counterparty and as the ability to help them in their design and construction processes to do well. Adds real value for investors to buy these assets from us and get a durable Japanese real estate return. This is business we're going to grow, and that's very positive. I think for all that's going forward. Page 27, next page. Continue to work to support growth in our REITs and Ichigo Green. You can see, even despite everything that's gone wrong in the world of COVID, Ichigo Hotel continues to pay actually a pretty good dividend. And that's, to be very clear, I mean, the REITs are yield assets in Japan. They're an opportunity for folks who can't get anything in the bank and haven't got anything in the bank for more than a decade to earn a decent return, and this is we expect as well. Next page, please. Specifically, we've done a lot on and focused on Ichigo Office. It's our biggest REIT. We think that look, there was less to be done during COVID for Ichigo Hotel. I mean, it was such a chaotic period. Just trying to keep it up and running, serve the operators, try to figure out how we fill the hotel was really important. So there was more activity happening on the office side. Now that we've had a rebound in hotels, you should expect to see us more active again on the hotel side also. But a lot of things we're doing, and it comes down to what I said earlier. Japan continues to have a desperate shortage of yield. Rates have gone up everywhere else in the world in a skyrocketing way. That has not happened in Japan. As you know, the BOJ has managed rates up a little bit. So the 10-year JGB target went from sub-zero from 0 to 25 basis points, 50 basis points. As a hypothesis, we would suspect that it goes something like 75, 100 basis points. It's not clear that's really going to end up showing very much in terms of yield for retail and institutions in Japan. So delivering kind of a robust yield without currency risk, without kind of geopolitical risk. Japan is extraordinarily stable economically, politically, and socially. Is something that we think is important for us, and we can work for Japan on that basis. Next page, please. To build up the clean energy business, we have a little bit of a drop off this year because there's going to be some large scale maintenance, and then it begins to grow into next year. We have ambitions to do a lot more. Let's do some stuff on green biomass. It actually, because green biomass runs 24 hours a day and has much higher, as part of the FIT process, feed-in tariffs, it actually has very high returns to it. So that's 6.8 megawatts, I don't know, we'll put that something like 5, think of it as kind of a solar equivalent. But we expect to see much more activity on non-FIT solar power at a minimum 15 megawatts, and probably will warrant that going forward. Next page, please. Shows our share buyback activity. The shares have been cheap for a long time. This is something we're obviously very focused on, and we need to fix. It is, however, an opportunity for us to buy our shares if they can get very good prices. We bought back over 10% of the shares in the last couple of years, and we could expect to continue to do so. Next page, please. We also moved on dividend. Haven't done that for a while, focused on buying back shares. At this point, it's like we kept the dividend at 7 yen for 4 years. It's time to push it up. Obviously, firm is very, very cash generative. We're fully able to do so. So we increase it by 40%. Next page, please. As you probably know, we are a top sponsor of the J League, Japanese soccer league. That was kind of tough during the COVID period since the stadiums were shut down. We're now back full on. Every time you go to a J League match, there is Ichigo all over the stadium. It's on TV. Very, very powerful for us from a branding perspective. We've made an unusual choice, and we think an utterly right choice. To take because we get all these tickets from the J League, and generally what companies do is like, great, we have tickets, let's hand them out to like management or to, I don't know, customers or something like that, or to employees, and we think we work for shareholders, and these belong to the shareholders, and so the tickets go to our shareholders and to the REIT shareholders, because again, we work for our REIT shareholders, and the same we work for shareholders of this company, and so we're the first company to offer shareholder program not only to our own shareholders, but to all of the shareholders of REITs and others. So and what's interesting, I think you'll probably see us more involved at the club level. A lot of conversations going on that could involve us being kind of a sponsor, sponsor not just at the daily top level, but at the club level, and have our names on jerseys and stuff like that. So we look forward to that. Anyway, that's what's happening with J League. Turn into the forecast. We have all in OP up 7% and cash EPS up 3%. It's probably very conservative, but it is what it is. We expect to beat those numbers. At this year's cash EPS forecast is 34.1 yen, 19 yen. That puts us at 8.3x. Current year earnings, and we think given the durability of the franchise, that makes shares very, very good, and growth makes the shares very good value. Next page shows the segment breakdown. Big push down in asset management. That's part of that's a drop off of performance fee. Part of that is we sold some assets. It does push down our assets under management, and to be clear, those are our values. I mean, we're not going to be at J-REIT is like, we're not willing to sell assets because it pushes down our fees. We manage J-REITs on behalf of J-REIT shareholders. So if that's the right thing to do, then we do asset sales, and AUM drops, our NOI participation drops, and that's the way it is. Now, having said that, we fully expect, we have commanded a premium valuation, particularly for Ichigo office, and we'll continue to do so going forward to grow the asset management business. But what's happening this year is some drop off in those fees, some decrease in NOI, and we're the only J-REITs, Ichigo Hotel and Ichigo Office, that have 100% success performance fee basis. So when NOI drops, that impacts us. It's also got some costs, increased costs embedded in that. We've both been conservative about revenues and conservative about costs. So I suspect we'd be some of it by turning up, but just so you know, that's what's going in there. Civil real estate on the other hand goes up. Sorry, we're still on that page by 29%. Clean energy comes off, and that's linked to the large scale maintenance activity that passes increased costs during this year, and then now we'll just come back for next year. Finally, last page shows how cash earnings move. We're not back to pre-COVID levels for either stock or flow. Obviously, we have to get there, and more than get there. So to get back to FY23 is not a goal of the firm to smash those numbers in a big way going forward. Is a goal of the firm. Thank you very much, everyone, for your patient listening. And we're now happy to take any of our questions or comments. Greg, thank you so much for joining. Go ahead.
Hi, Scott. Can you hear me?
I certainly can. Thanks so much.
Okay, great. Thank you for the presentation. I have 3 questions. The first one is on hotels. Can you describe a little bit how the recovery was for RevPAR versus your expectations overall, especially the second half of last year?
Yeah. Do you want me to take the questions one by one?
Up to you, whatever you prefer.
You can tell me all 3 and I'll answer them. That's fine. Go for it.
Okay, sure. The second question is with regard to Ichigo owners. So you, as per your presentation, you're suggesting that the gross profit margin is going to come down. Is that because of rising costs or kind of more hesitation on pricing from the point of view of the buyer? And also, I noticed on the slide that you are forecasting more sales than buy this year. Is that reflecting a kind of slightly different environment? Would be my second question.
Yeah.
And then my third question would be if you are able to give us an update on the asset sales for 15 billion, and would that be the reason behind the guidance? Thank you.
I'm sorry, the asset sales for on which page you want?
For the 15 billion hotel sale that was cancelled by Ichigo REIT in March.
All right, so hotels. We disclosed the RevPAR move. I think Greg, thank you for all 3 very good questions. On page 7.
Yep.
So, I mean, one of the things that's interesting, and we should address this. These are very low RevPARs, right? I mean, it's 6,000 yen at current exchange rate. We're talking about like $50. And one of the things that's clearly happened in the Japanese hotel market is that more expensive hotels have substantially outperformed. It's both a function of high net worth having done relatively better in Japan, as is the case across the world, and going through kind of the economic shocks of COVID. Them having more kind of disposable income and savings to be able to, when COVID reopens up, say, I'm going to go places and catch up for 2 years of lost life. And kind of cheaper, the yen getting weak, and so having more inbound activity. And so one of the things we think we need to fix is that our RevPAR is still actually at this point only running about 80% of pre-COVID levels. And when I say fix, we need to be thoughtful about. So this has been, we specialize in 2 kinds of hotel assets. One is budget, and the second one is the not, which is a higher boutique hotel one. And the not is clearly the place we should be going. It just, the ability to have kind of the willingness to pay on the part of Japanese and event travelers is higher. So migrating a RevPAR up higher is positive. It's a way of saying these numbers are actually, we think, disappointing. That RevPAR should have grown more. And we think that we have to do some work as a company to get there in terms of thinking about our hotel performance. So less on the budget, more kind of a mid-tier, US dollar per night, $100, $150 a night is where we think there's going to be more growth going forward. And so you'll see hotel sales on our part that kind of, and if you see hotel activity on the purchasing side, although we're not super ambitious on that right now, given that we still have low NOIs and/or you have higher NOIs for these assets that are more expensive, and one wonders about whether more people like us who are seeing the market opportunity will add supply and will take away that. So we're not super inclined to kind of reach and start paying, top value for hotels. But anyway, direct answer to your question is great RevPAR recovery. We think this year's numbers, we've been very conservative on. We think we'll see more RevPAR recovery. We'll see outperformance in hotels this year relative to what we penciled in for the forecast. But we will be migrating more of our activity towards things more like the Knot as opposed to classic budget hotels. Did that answer your question?
Yes, thank you.
And then Ichigo owners, that would be page, what did Ichigo owners page? 25. So let me be very direct. You have asked totally appropriately, why is this weak and what would be the reasons for it to be weak? And it's not clear to me that the reasons for it being weak or anything other than we've just chosen to be cautious on the forecast.
I see.
Okay. I mean, we want to give numbers that we hit. There is, there's a big enough activity here that impacts total earnings. We chose some numbers relatively conservative, but I don't see decreased demand. I don't see weakness in pricing. There's a little bit of wobbliness going on with global investors, but it's who have problems with kind of the global PE funds, and there's some shift of activity globally away from real estate, as you can imagine, towards bonds, because real estate financing has gone up, and occupancy outlook looks weaker, and bonds are paying a lot more, but that hasn't happened in Japan. So, my hypothesis, and I speak on hypothesis because it's smarter to have a hypothesis and test it against evidence as it emerges, as opposed to have a view, is that the little bit of wobbliness in global demand is going to be met by continuing kind of voracious appetite for a decent return in Japan. As you know, there's some repatriation that's already occurring. The Japanese portfolio allocations overseas, in part because you can finance, you can do hedges on global bonds, both in the US and Europe primarily, and outperform Japanese bond yields. You cannot do that anymore. It's gone deeply negative. So money comes to Japan, it needs a return. You're not getting that return in bonds. So we see substantial domestic activity coming towards Japanese real estate. So it's a way of saying, my current hypothesis is that we actually get this number and we come in with something that looks like that we did last year. It looks more like 14%.
Understood. Thank you.
And then on the hotel asset sales, we think we'll get that done. We're very unfortunately, and it's all on us. We were going to do a hotel offering. There was a miscalculation. Honestly, it does not appear to have been material. It was about historic financials. It was not very big. But when you're doing a public offering and trying to sell things to retail investors in Japan, you have to abundance of caution, et cetera, et cetera, et cetera. So we canceled the deal. So we'll see. We think that's just going. And to be very, very clear, as I said earlier, we sell assets to our REITs at below market prices. So if the alternative is we go into the market and sell the assets, we'll sell them at a higher price. So that's where we are now.
So you are saying that your strategy was to focus more on the Knot. If I remember correctly, one of the Knot hotels was actually for sale as part of that batch of hotels. So would you take it back from the batch and keep it for yourself, so to speak, and maximize the value there?
We don't intend to sell the Knot which is a Ichigo franchise, outside at this point, outside of Ichigo itself. So actually, they're not in Sapporo. Sapporo,
Yeah.
Yokohama, we're going to the hotel REIT. And so, if we decide not to sell, to the hotel REIT, and we'll mix up our, kind of our hotel asset, kind of sale category. But, and I talked about this before. I mean, generally what we do every year is we'll line up, like there are 10 assets that we could sell to hit our numbers, and we'll run a sell process on 20 assets, literally. Because you do not want to kind of just going to go for one corner shot on getting to your numbers. It is a way of saying that we also tend to have an abundant source of assets to sell because of the value add activity that we do. But yeah, you're right. If we don't sell to the hotel REIT, we will.
Then you keep it.
We'll
see.
keep it.
But am I inferring correctly that the guidance may look a bit conservative because of the uncertainty on the 15 billion yen of sale of hotel to the REIT? Yeah.
I mean, there are a number. Having said that, it is also the case that we try to be thoughtful about showing, because we show segment level guidance also, that we have numbers that kind of make sense at the segment level. But in general, we look for like 7 to 8 ways to get the yes on the hitter numbers, and so that's not the only element, but yes, there was a little bit of that in this year's forecast conservative.
Understood. Thank you very much.
Okay. So there is a question as to why we've increased the Ichigo office stake to greater than 30%. And to be clear, that's primarily buying activity out of Ichigo Trust, so a major shareholder, and not us ourselves. We did begin a Ichigo office buyback earlier in the year, and that's ongoing. And that was directly linked to wanting to, and I mentioned this earlier, to create very high levels of alignment between ourselves and the REIT shareholders. We think the REIT asset class is really productive, meaning that it is a great way for, and one of the few ways outside of kind of high yield equities, given the lack of yield in Japan, for Japanese savers to earn a decent return. And the JV market has not grown nearly enough. It's been plagued by kind of concerns about sponsor conflicts. And so to try to do everything we can to demonstrate structurally our values, that we care and that we're aligned with our REIT shareholders, we think is really important. So anyway, that's what's going on with the office REIT purchase activity. Thank you for your question. And the next question is, can you disclose the investments in Ichigo Trust? Well, Ichigo Trust invests primarily for, yes, I mean, not by name, of course. And again, I'm here as chairman of Ichigo Inc. today, as opposed to talking about Ichigo Trust, but that's fair enough question. Primarily charities, actually, endowments and foundations, mostly in the US, also in Europe, also globally. So very long term in its approach, and something that Ichigo feels proud about. And the major owner of this firm is primarily endowments and foundations. They're trying to make the world a better place. So for all of us to contribute to them, for all of us to take on those values and to work for the world is something that we find really meaningful. Okay. Thank you, everybody. I'm grateful for your time, and it's an honor and a privilege to work for all of you. Take care. Have a good day.